All right, we'll jump into things. So hello everyone, welcome. Again, my name is Sarah. If you have any questions after or during, feel free to shoot me a message. But thank you so much for being here and joining our exciting workshop and webinar around end of financial year for startups. So if you're an aspiring founder or a current founder at the moment, there's a lot of logistics around this time of the year. So we're excited just to run everything through you and hopefully get you well prepped. And if there's anything that we can do for you afterwards, please reach out. So we'll jump to the next slide. We've got a quick disclaimer. I will be sending the slides through afterwards as well. So feel free to take a bit more of an in-depth look then. All right, jump to the next slide. Okay, so this webinar is being hosted by our wonderful tax manager, Tanya. Also recently became COO, so a little shout out and congratulations. Tanya is amazing, and so I know you'll really enjoy her presentation. And again, she's an amazing person to ask questions to if you have any kind of questions or curiosities afterwards. And let's jump into it.
Thanks for that, Sarah. Hi everyone, I'm Tanya, tax manager and now COO here at Fullstack. And today we're going to be going through everything startup. So end of financial year, as Sarah said, is a fairly busy time. Can be quite a stressful time for anyone who either hasn't been through it yet or may have had a bad experience before. So we're just going to try and ease you through this this end of financial year so that you can do 2022, shut it off like a pro. We'll start by going through the agenda. So we're going to go through the income and deductions side of things. We'll touch on corporate structuring, ESIC status, ESOPs, R&D, and prepping for it for end of financial year, planning for installments, trust distributions and dividends, and then if you have crypto in your entity, how to correctly record it, recognize it within your accounts. So let's get started with income and deductions. Before the 30th of June, there are a few things that you can do to proactively finalize the financial year. And we'll go through a few of them now. The items that we mention here are they're tax planning strategies, but they're also good for general administration and maintenance of your accounts to make sure that when you do get your tax return prepared, everything's there, it's in place, and you don't have to worry about trying to find things after the fact. So the first thing that we recommend is reviewing your loan accounts. If you've taken any money out of the company, review it, and if you have any minimum repayments to make, do so before the 30th of June, just to keep it clean. Another cool tip that we can recommend is paying your employee super and bonuses a few days before the 30th of June. So by paying it before the 30th of June, you get the tax deduction in the 2022 financial year. And it just means that if you're in a profit position and you would have had tax to pay by paying it a little bit earlier, so instead of on the July due date, you then get the tax deduction in the 2022 financial year. Also recommend that you scrap obsolete assets, raise any inter-entity management fees. If you have trading stocks, if you have physical stock, perform a stock take, identify your obsolete stock, and choose your valuation method. Now, valuation methods can change from year to year. So you can have it as cost value, market value one year, and you can have it cost the other year. It's up to you. And you can also have different methods for different items of stock. So it's up to you, but when you are making that decision, make sure that you are recording it correctly in your accounts. A few more items. This is more with regards to tax planning, this side. So tax debts, bad debt, make sure that you write them off prior to 30 June 2022 to be able to claim the deduction. Look through your accounts, see what's unlikely in your accounts receivable, see what's unlikely to be received, and write them off so that you can claim a tax deduction and your tax agent knows that you get that deduction. When it comes to prepayments, there's a 12-month rule for small business entities. So if you're a qualifying small business entity, you can deduct any expense that will likely fall over the next 12-month period. You can deduct it when the expense is incurred. So this is important for things like subscriptions paid up front, insurances. If you pay your rent maybe on an annual basis, then as long as it's covered in the next 12-month period, then you can take the deduction in the year that it's physically incurred. So there's a $50 million threshold that applies. You can't claim prepayments for more than $50 million, and a non-small business entity has to identify their excluded expenditure. Since we're assuming that everyone that's joined the webinar today is it would be a small business entity, we're going to not delve into that one too deep. Deferring income is a really effective way to plan for tax. So if you have, at the end of the financial year, if you have received some income in advance, so you have received those subscriptions, let's say someone has signed up for your service, if you're a SaaS, they've signed up for your service and they've paid for 12 months in advance, then you can declare some of that income you can apportion it to the period that is yet to happen. Meaning you can defer the income out and not pay tax on it in the year that it was physically received. So that's something that we highly recommend you look at, especially if you're receiving income that might fall over a service period of more than just one financial year. Work in progress is another for those that have items that they might manufacture, or they might be in a service related industry, that you look at your work in progress at the end of the year, and that is another item that you can add to your deferred income and not pay tax on it until the work has actually been completed. The next item is temporary full expensing, which I'm sure everyone would have heard of. It's been extended until 30 June 2023. To qualify for temporary full expensing, which basically means any assets that you purchase from 6 October 2020 to 30 June 2023, you get a full-on tax deduction. There is no limit to the amount of the asset. You just need to qualify by carrying on a business, have an aggregated turnover of under 5 billion. The asset must be used mainly in Australia and mainly to carry on business, which is important. And it must be first held, used or installed or ready for use between those periods, which is 6 October 2020 to 30 June 2023. So these are for new assets. So new assets, there's no limit. For second-hand assets, if your aggregated turnover is the turnover of your entity and each other connected entity within your group. So the aggregated turnover, if your aggregated turnover is under 50 million, you can claim the temporary full expensing. You're fine, you don't have any special rules. But if your aggregated turnover is more than 50 million, then you can't, it's unlikely that you'll be able to claim the temporary full expensing on second-hand assets. You would still be able to claim the regular depreciation. There's no, it doesn't exclude you from claiming it from the normal depreciation rules. It's just the temporary full expensing. It's unlikely that you'll claim. With this, what I will say is try not to splurge on items that won't improve your bottom line. So by spending $1, you're saving 25 cents, which is the tax rate. So that's the 75 cents that you're actually spending, the cash that you're actually spending, that has to have a nexus to your income. Otherwise, you're not improving your bottom line and you're sort of just buying things just to get the tax deduction, which is not really wise. So if you are in the need to buy assets, go for it, use temporary full expensing. It's great cash flow incentive from the government, but no need to buy things that it's unlikely that you'll ever use or that you don't really need. Because in startups, we try and preserve cash. We want to preserve our cash so that we can have our runway stretch out as far as we possibly can to get to the unicorn status. Another quite important term that's been announced is the loss carryback rules, and we get quite a lot of questions around the loss carryback. So I thought it would be good for us to just cover off on this one, even though it doesn't really relate to income and deductions. But the loss carryback rules is a refundable tax offset where losses that you made in the 2020 to 2023 financial years or tax years can be offset against your profits made in 2019 to 2020. Now, it's a little bit of a reverse on what we would normally see with losses. So what would usually happen is you have a loss, you carry it forward until you have a profit, and those profits then eat into the losses. And then only once you've eaten into all of those losses and you sort of break even with your profits, that's when you start paying tax. Now, what the loss carryback rule tries to do, it basically says in prior years, in the 2019 to 2022 year, if you made a profit and you paid tax on it, then you can carry back, you can claim back the tax that you paid on that profit if you made a loss in a year following the year that you made a profit in. So it's sort of saying that you don't have to wait until you make losses again and then profits again. It's allowing you to sort of claw back the tax that you have paid on profits prior to the year that you've made a loss. The thinking behind it is COVID has hit hard for everybody. Technology businesses seem to be doing really well, which is fantastic, but the government is saying we want to invest in other businesses as well. So we want to give you that opportunity. So if you've had a profit and you've paid tax on that, you would be allowed in the following years, when you do have a loss, you'd be able to claw back the tax that you had paid on those profits in prior years. The tax offset will be the lower of the company's franking account balance. So the franking account is basically the balance of how much tax you have paid, less how much franking credits you have used to pay out dividends, for example. So if you look on your tax return, on your prior year tax return, so if you have a chat with your accountant, they'll be able to tell you what your franking account balance is. And so the tax loss that's being carried back would be reduced by net exempt income, and it's just multiplied by the company's tax rate for the loss year. So you don't really get the tax rate that you paid. So let's say you paid 27.5% when you made the profit. You don't get the whole 27.5%. You get to claim it in the rate of the current year. So let's say it's 2022. The tax rate's 25%, so you get to claim the tax loss that you're carrying back. You get to claim the tax credit of 25%, not the 27.5%. But your tax agent will sort that out for you. To be eligible to get to apply the loss carryback rules, all of your tax returns for the current year and the previous 5 years have to be lodged. So even if it's a return not required, everything has to be up to date. Aggregated turnover, again, aggregated is that of yourself and any other entities in your group associated with you. And so your turnover has to be under 5 billion, and prior year tax debt that remain unpaid at the end of the current year can limit your tax offset, which makes sense. You can't claim something back that you haven't physically paid. That's sort of logical. Other items to consider that will change on the 1st of July 2022. So from the 1st of July, the superannuation guarantee will increase to 10.5%. That's superannuation for your employees. It's very important from the 1st of July to check your payroll software, make sure that you've got all of your employees set to 10.5%. Depending on the initial setup of your payroll, if you did, if you set the rate as manually, says to 9.5 or 10% is what it currently is, then you'll have to manually update it. But if it just says statutory rate, then software like Xero or Mild, whatever you're using, they will automatically update it. But we do recommend double checking, triple checking to make sure that you're paying at the correct rate. The superannuation guarantee rate will also continue increasing by 0.5% each year, and then by 1 July 2025, it'll be 12%. And so far, we don't know exactly where it's going to go after that. Another important thing with employee super is that the $450 super guarantee threshold has been removed. So you used to not have to pay superannuation if the income for an employee in a monthly period was under $450. That has been removed. So each and every dollar that you pay to someone who is an employee or who qualifies as an employee, so that can be contractors who qualify as employees for superannuation purposes, even if you just pay them $5, you have to pay superannuation for them. So it will become very important to collect superannuation details for everybody that can potentially be considered an employee. The argument of, I didn't have this person's superannuation details, so I could not pay their superannuation, is not a valid argument. So it's the burden is on you to make sure that you have that super. So what I would recommend is you don't pay anybody their first salary until you've got their superannuation details. So you sort of hold them accountable for supplying that information. Another change is the small business tax installment. So the uplift factor, it used to be 10%. It's now 2%. And we'll go into that a little bit later in one of the other slides, but it basically just means companies get to those who enter into the pay-as-you-go installment regime get to hold on to their cash for a little bit longer. This is quite a big win for those who have to go into the pay-as-you-go installment regime. Then trust distributions and loans owed to company. There's a massive change that's happened with the ATO. It's been coming a really long time. And what we're trying to warn about here is just be wary that there are some massive legislative changes coming up. You may have heard of Section 100A and the implications that the recent announcements from the ATO might have on trust distributions. So we'll go into that a little bit later, but just be mindful that there are changes. So any distributions made from 1 July 2022, be careful and make sure that you're falling into one of those categories, preferably the blue category, but we'll go through that a little bit later. We've had quite a few questions about this one. It was announced in the 2022-2023 budget. I have to note it's not legislation yet. So this is the skills and training boost. We'll go into the technology investment boost just after this, but basically who's eligible: small businesses with an aggregated annual turnover of under $50 million. What's eligible? So what the budget talks to, and this is all just speculation at this stage, it depends on what the current elected government will do. But what they're saying is eligible training courses provided to employees between 29 March 2022 until 30 June 2024 will be eligible for an additional 20% tax deduction. So if you spend $100, you can claim $120 on your tax return. What constitutes eligible training courses provided to employees? There's no guidance on that. We have no idea. So at this stage, it's all just speculation. And what we would recommend is if you do have training coming up for an employee and it's not urgent training and you might want to claim the skills and training boost, just wait until the legislation drops, so that if you do want to claim that extra 20%, it sort of falls into that category. So as I said, we don't know much about it yet. What we have here is literally what is available through the budget. We're waiting for the government to release even just the draft legislation. We don't have anything yet. We just have the announcement from the budget. Second one is basically the same eligibility, same deduction methodology, about the extra 20%, same timing. But what this one would cover is expenses incurred in advancing your digital adoption strategy. So anything that you would use to go digital. They give examples, payment devices, that would be any portable payment device that you can have anybody pay electronically. Payments for cybersecurity, any cloud subscriptions. So for most of our clients, this is a win. If this gets legislated, it would be a win on two fronts. Most of our clients have really high cloud subscription services. They have high subscription expenses, and they also charge cloud subscription expenses. So it's a selling point, and it's a tax saving. So we're really hoping for this one to go through. We'll talk briefly about corporate structuring. This is this can be a very lengthy, very detailed topic, but we'll quickly touch on it. We do have a lot of resources available on this, and we can go into a bit more maybe in a separate webinar. But on this one, we'll just quickly touch so that we can show you what the different options are. So the first option, this is aimed for those who might be in a particular structure. So let's say you are in a partnership, or you are just a sole trader, which is not really tax efficient for most situations, and you're looking to incorporate, maybe say by the new financial year, by 1 July, you would like to be incorporated. These are just the options that you might consider. So the first one is just a basic company. So this one has the family trust that holds the shares on behalf of the founder in the trading company. There's no holding company. So everything just goes through the trading company. The reason why we recommend the family trust hold the shares is just for asset protection. And there are some limited tax planning capabilities available there. But the biggest thing is still just for asset protection. So a step up from that is having a holding company. So for those who have large investors coming through, or who might be in a very litigious industry, we look at getting a holding company set up. So you would have the holding company and the trading company set up from the get-go, so that the IP and any investors would invest in the holding company. The IP would be protected within the holding company, and then the trading company is the one that takes the risk. So it employs the suppliers, it employs the staff, it contracts with contractors, and if something goes wrong within the trading company, then unless there was fraud or any of the other reasons that they can sort of lift the corporate veil, the holding company and the IP is protected within that holding company. And then if the trading company does go down for some reasons, and if we consider that there's no illegal phoenixing going on, you can just establish a new trading company and potentially do a different venture. The structure is also really helpful if you are thinking about having substantial investors and sometimes overseas investors, but we won't go too much into that in this webinar. Similar to the one just before, this is just one that has to do with multiple founders. So it's exactly the same. It just has multiple founders and they all feed into the holding company and to the trading company. Next up, we'll look at the ESIC status and reporting. So ESIC is the Early Stage Innovation Company Incentive, and eligible investors who invest in an ESIC company would get a 20% non-refundable tax offset that's capped at $200,000 per investor per year. So this is a good item to sell to investors, to get investors to invest if you are a qualifying ESIC company, and they can get up to 10 years CGT free. So the requirements to be an early stage innovation company is you have to have been incorporated in the last 3 income years. Your aggregated expenses for the prior year needs to be below $1 million, and your assessable income needs to be below $200,000 for the year just prior to the investment. So if they invested in the 2022 financial year, the test year would be the 2021 financial year. If you were not incorporated in the last 3 income years, you can also get through by being incorporated in the last 6 income years. So you can be up to 6 years old, but then your expenses over the last 3 years, the sum of the expenses of the last 3 years have to be under $1 million, which is quite high, which is quite a low threshold if you're actively trying to build an entity. The tests to be an ESIC, once you've passed the early stage test, you can go on to the next 2 tests, and we go into that a bit more detail. You've got the innovation test. So for that one, you have to meet 100 points, and you just use the scale that's available. So sufficiently large R&D claim, AC grant, accelerator program, prior 30-year party investment over 50K, innovation or standard patent, and you can co-develop it with a uni or a research service provider. So if you're eligible for any of these and your points add up to 100, then you get through on the 100-point innovation test. You also have the principle-based innovation test, and for that you have to prove that you have developed significantly new or innovation for commercialization. You have to have high growth potential. There must be potential to scale. You must address a broader market, not just the local market, and you must prove your competitive advantages. So ESIC is a self-assessment. It's a self-assessment regime, but you do have some reporting requirements. So before the 31st of July each year, so that's coming up 2 months from now, you have to report for each investor that invested in the last financial year. You have to get this information from them, and you have to lodge it with the ATO. You also need to make sure that you are issuing any shares and providing the share certificates to the investors from the prior year by 30th of June to make sure that all of that marries up. So a few other things to note on the ESIC. So investors will have to determine their personal eligibility, whether or not they are sophisticated investors that qualify as someone who can claim the investment that they made into an ESIC. That's not up to you, that's up to the investor. Companies may request a ruling from the ATO to confirm their eligibility status, but the ATO won't give you a ruling on the 100-point innovation test. And then remembering that the test time is immediately after the qualifying investment is made. So a company may have multiple test times during a financial year with different results. So each time that someone wants to invest and they ask you, are you an ESIC, you would do the test and make sure that you still qualify. Flying. Next up, there's a lot of information, I'm aware, but we will be sharing the slides afterwards. Next up, we have ESOP and ESS. So most of you would know that about the employee share schemes, and basically the important things to remember here is that at the end of the financial year, so on 30 June, you need to value your ESOPs, those that have been awarded or those that are vested or executed, and you need to include them in your accounts at the 30th of June. It's quite a complicated calculation. So we usually recommend using software or using an app to make sure that your vesting periods and everything is calculated. We do have a few suggestions if you guys want to reach out and have a chat about what's available, what's out there, happy to share. And if the startup concessions apply, so the ESOP startup concessions, then the tax will be deferred in the hands of the employee. So they won't pay tax when they get the shares, they'll only pay tax once they've disposed of the shares or they've sold it. And each year by the 14th of July, you need to submit the details of all of your newly issued ESOPs or share schemes to the ATO. So eligibility for the startup concession, where the employees get the deferred tax, the company can't be listed on any stock exchange. Any companies in the group has to have been incorporated within the last 10 years, because it can't be older than 10 years. Aggregated turnover, again, under 50 million. The discount that they receive can't be greater than 50% of the market value of the shares. The main business of your business, the one that they're getting the shares in, can't be the acquisition, sale, holding of shares, securities, or investments. The company must gainfully employ the person who is receiving the ESOP, and employees are not allowed to dispose of their shares before 3 years from the grant period. So they have to hold it for at least 3 years to qualify for this. Can only be for ordinary shares, can't be preference shares or anything else. And no employee may hold more than 10% of the company's shares. So if all of these are met, then the tax will be deferred for the employee, which is a great outcome. All right, so next up we'll go to the R&D Tax Incentive. Again, this is a very wide area, and we would usually spend a lot of time on it, but we're going to try and rush through it just to give you the highlights. And happy to have a chat afterwards. We have a really great R&D team that can take you through the nuances and the details in more detail. So the important thing to remember for R&D tax end of financial year prep is that within 10 months of your year end, you have to submit your claim to Oz Industry to make sure that you actually get that claim in, and you can claim the R&D when tax time comes. So then after the financial year ends, you can lodge a tax return to claim your R&D. But what we're going to go into a little bit more here is before year end, what you must do. So before the 30th of June, again, the same as any other tax deduction, prepay any expenses, pay employee super liabilities. And with this one, what's important is pay amounts owing to associates. So any related parties that have a salary or a contract fee or anything attributed to them, that can only be claimed if physically paid with cash. So you can't provide for a salary for the founder and say, oh, they did work worth $100,000, but we're not going to pay them yet, because then you won't get the R&D for it. You'll only get the R&D once it has physically been paid. So that's a very important one for R&D. So what expenses could be eligible for R&D? You've got contractor expenses, salaries and wages, research service providers, and decline in value, which could be the temporary full expensing. So if you use the temporary full expensing, it doesn't exclude you from claiming the R&D on that. So anything that you can claim as a tax deduction can be considered if relevant within your R&D claim. On the type of record keeping, we just go into two really broad areas. So activity-based record keeping is mainly used to just demonstrate that the R&D was actually carried out. So meeting notes, timesheets, things like that. And expenditure-based record keeping is to justify the dollar amount for the R&D, and you need to do both. So you need to have both of these to substantiate your R&D claim. Our biggest tip is make sure that you're preparing your R&D sort of substantiation documents as you go. Trying to recreate the documents at a later stage is really difficult and costs a lot more time than it does to just have it as you go, as you're taking on these activities, maybe putting it to an account that specifically says R&D, flagging it maybe with tracking categories. Highly recommend making sure that you do it as you go and not waiting for the end of the financial year. So what we'll cover here is just that the R&D tax offset is 43.5%. And if you have a tax liability, then so if you are paying company tax, then your company tax will be offset by the R&D refund, and you'll get the balance paid to you. So if you were eligible to get 100,000 worth of R&D refund, but you had a tax bill of 25,000, then you get 75,000 R&D as a refund if you qualify. The next big cash flow planning thing for all startups is planning for installments, and we'll start by explaining what pay-as-you-go installments are. So pay-as-you-go installments are basically you prepaying your tax for the year that you're currently in. So we're all used to paying tax at the end of the year. Once you've lodged a company tax return, you get a tax bill, say you've got $50,000 that's due, you then have to come up with that $50,000 and pay it to the ATO. What the ATO will then do is they will enter you, if you have a tax bill due, they will enter you into the pay-as-you-go installment regime, which will mean you'll have to pay last year's tax, and you would have to come up with the tax of the year that you're currently in, so that you're prepaying for the year ahead. This is usually a big shock to founders because they've never been told, or they've never experienced the fact that you will have that catch up here, that sort of catch up year where you have to pay the tax of last year and the tax of this year. So what we highly recommend here is just making sure that you put aside, if you see you're in a profit position, put aside the cash that's meant for the ATO. So if it is the tax rate's 25%, and if you see you're making a profit or you're likely to make a profit, just put that money in a savings account. Don't spend it. It's not yours. When tax time comes and you realize that you made less of a profit than you thought you would, that's when you can spend that cash. But it's never your money. It's never going to be your money. You wouldn't want your business failing, or that shock just from the fact that you didn't plan for this properly. What the ATO is doing though is they have changed the uplift factor for the 2023 financial year, basically. So it just means that if you're using the pay-as-you-go installment method, the percentage-based one, then you'll have more cash during the year. Your tax bill at the end of the year will still be exactly the same. So it's not going to change the amount of tax that you have to pay. It just means that instead of having that 10% uplift factor, you now only have a 2% uplift factor. To be eligible for this, you have to have under 10 million annual aggregated turnover for GST installments, and if you have GST installments, and 50 million, so under 50 million aggregated turnover for pay-as-you-go installments. So if you qualify for that, so basically a small business entity, if you qualify for that, then you will automatically, your uplift factor from the percentage that the ATO issues you as your pay-as-you-go installment percentage, it will be lower than it would have been had they not introduced this method. So what we highly recommend, like I said before, estimate your taxable income. So for 2022, for example, you would work out, you have a look at your accounting system, look at the 30 June 2022 profit. If you have a profit, because there's still a month left, you would use the last 11 months divided by 11, multiplied by 12 to get the extrapolated annual figure. Less temporary full expensing if you've been putting those items in the balance sheet, just make sure that you're taking that into consideration, and add back unpaid super. So as you can see, super reduces your deductions. So it takes away the amount that you can get as a deduction for superannuation. It increases your taxable income. So if you have nothing outstanding, there's nothing to add back. Then you'll get your estimated taxable income, multiply that by the 25%, which is the tax rate, the base rate entity tax rate for 2022, less any pay-as-you-go installments that you may have paid, and then less the refundable R&D tax credit if you are aware of what that might be for you for this year. And then you'll get your tax payable or refund due. Then that money, put it away. If it's a refund that's due, lodge as early as possible. Make sure your accountant has all of your information early on so that you can get your refund quickly and just keep doing what you do best. Trust distributions, we touched on that briefly and earlier, and I'll just go into a little bit more detail to explain the different zones and where you should be, when something should flag that there's a problem. So any genuine trust distributions are fine. So don't worry about that. What we do have to be worried about is when we are trying to create a situation that shouldn't really exist. So the blue zone, which is the one that we'll look at, the blue zone and the red zone, and these come directly from the ATO. It's not something I made up. So this is the usual situation of a trust distribution, and money is paid out. A distribution is made. The funds may still be held by the company, and it doesn't fall into the green zone. So it's not seen as a safe arrangement or a regular arrangement. It might be a little bit contrived. The ATO may review it, so they'll try and have a look and see whether or not there's anything for them, if there's any mischief going on there. So if it's anything that is not one of the items in the green zone, then it automatically falls into the blue zone. So just be wary of that when you are planning your trust distributions for the 30th of June. So the red zone, those are arrangements that will be reviewed in great detail by the ATO, and they have not been shy in telling us how much resources they will send after these people. It's been a long time coming. So definitely something that you need to have a second, third, fourth look at before putting pen to paper and making that decision. So they'll look at adult children, so distributions to trust distributions to adult children, trust distributions to entities with losses, and circular arrangements. Adult children is basically where you are saying that things that you would normally pay as a parent, that forms part of the trust distribution, and that's why the kid's not getting the money. So the example that the ATO uses is private school fees. So that's something that you would usually pay as a parent. It's not in addition, it's your parental duty to do that. You can't, for example, say, because I've bought you food for the first 18 years of your life, you now owe me $700,000, and I'm going to attribute this income from the trust to you and save tax on it as I go. So anything that falls within your normal parental duties of caring for a child, you can't claim. The ATO will review it, and they will probably come out and say, well, no, not really. That's not how it goes. And once they've picked 1 year, so once they've pegged 1 year and they've picked up that you've done this once, that it's within their rights to try and open up previous years as well. So be very mindful of that. Entities with losses. So if there's a trust distribution going to an entity with a loss, and there's no payment being made, it's literally just so that you can stuff income, the taxable income, so that you can stuff it in the entity with the loss. The money's not flowing to the company. Nothing else is happening except for the trust distribution. The ATO will definitely be looking at those. So if the cash doesn't follow the distribution, it's just a tax arrangement, then it's likely to be reviewed. And for all of these, what the outcome will be is the ATO will deem, they will tax it at the top marginal rate, which is 47%. So they will go as hard as they possibly can on this. Circular arrangements are a fun one. It used to be all the rave back when accountants were doing this for tax planning, and it has now caused significant issues. So if you have any older companies that still have these unpaid entitlements, unpaid personal entitlements in place, I recommend talking to your accountant and making sure that you're sorting those out, putting them under the complying agreements and things like that. But what the circular arrangements are, I like to explain it as a snake that's eating itself. So you have this entity that has a trust attached to it, and the entity distributes to the trust and then issues a frank dividend. Sorry, the trust distributes to the company issues a frank dividend. So what's happening is it's just constantly doing this. And it's just a tax deferral method. There's no real end game. There's no real end to this. It just keeps going and going and going and going. Once off or a second off, like a once off or a twice, once in a while arrangement where something like this happens is unlikely to be looked at very with a frown. But if it is something that is constantly happening and you're only having that snake eat itself, that wheel of death going on and on and on, be ready for a review from the ATO. Next up, we'll go to dividends. So with dividends they go hand in hand with our director loans. And what we see happening a lot is founders, directors just taking money out of the company because they're not getting a salary. So they might pay for them for their personal things. They might use the company as their personal bank. And we're going to ignore FBT for this presentation, but there's probably FBT implications as well. But what will happen is if you're taking money out of the company, that will be accumulated towards a loan account. So director's loan account, shareholders loan account, and at the end of the year, you'll have to repay that to the company. Otherwise, something that's called Division 7A, which is a rule that tries to tax you on the money that you've taken out of the company, might kick in if you don't have that complying agreement in place. A way to do that is, a way to combat that is if you did have a profit, then you can take money out of the company via a dividend. So the best thing about making money in a company, having a profit, is being able to see the results of that profit in your personal bank account, because isn't that why we're all in business? So, so you've made a profit. If you have paid tax in prior years, physically paid the tax in prior years, then you could have franking credits available, which means that you can pay yourself a fully franked dividend. And what that will mean is you only pay the top-up tax. So you get the benefit of the tax that the company has already paid. So let's say the company paid tax at, say, 25%, and the franking rate, the deduction or the franking credit that you get to use on your dividend is 25%, and your effective tax rate is, say, 30%, then you only pay tax on that extra 5%. You only pay that extra 5% tax. According to your marginal tax rate. So it's a great way to get money out of the company if the company has paid tax before. Next one that can also go on very long, but we'll keep it short for this, is just the recognition of cryptocurrency that you might have in your company. And what we're looking at here, what we're looking to cover is just if you had invested in cryptocurrency during the year, and you're a normal trading company, but you have used some of your cash to invest in cryptocurrency, what do you have to do before the end of the financial year? So what we highly recommend is making sure that you have a portfolio of that somewhere. So using some sort of a tracking software to sort of keep track of the purchases and the sales and the swaps between the two, between any different coins. Highly recommend that, so that at the end of the year, when you submit everything to your accountant, it's easy to capture all of those movements. If you were trading, there's a different way to take care of things. So if you are actively trading in cryptocurrency, so actively trading can be seen as multiple transactions on a recurring basis, and you're doing it in a business-like manner, then it will be treated as trading stock. So it will actually become stock. So any purchases that you make will go into your P&L as purchases, and any sales that you have will go into your P&L as sales. Then whatever you have left over at the end of the year will reduce your purchases by putting the closing stock in. And to do that, you would need those reports from your coin tracking software. You would need the reports that say when you made which transactions and the Australian dollar equivalent at that very second that you made that transaction. Just very briefly, if you accept payment in cryptocurrency, this is something that's coming up a lot right now. Basically, if you're accepting payment in cryptocurrency, it is payment just as it would be payment if you received it in cash. It's the exact same thing. So there's no special treatment. If you were doing sales, let's say you are selling a service, if you were invoicing someone, you would still invoice them with normal GST on it, but the only difference is they would pay you in cryptocurrency, and you would capture that payment that you've received in the Australian equivalent in your accounts. And any goods that you make would be basically exactly the same thing. Any purchases that you make with your cryptocurrency, if there was GST on the invoice and you paid with cryptocurrency, you can claim the GST back. So in this instance, think of it as it's a normal way, a normal payment way, except it's with cryptocurrency. If you are in the field of trading with cryptocurrency, be aware that there might be GST rules that apply. So this is something that we highly recommend you get advice on. It's a very complicated field that we can't go into right now, but just bear in mind that if you're trading in cryptocurrency, you may have a GST liability that you need to look out for. And we've touched on the holding it as trading stock. So all we want to say there is that the CGT exemptions they don't apply to companies. So you don't get CGT concessions for companies. But if you are, say, a sole trader, then there might be CGT concessions on assets on cryptocurrency that you hold. But for trading, there's no CGT concession available. And then lastly, we'll get into the important dates. So there are a few important dates that are coming up, quite a few, but we'll share the slides with you afterwards so that you can have a look at them. In the immediate future, so in June, we've got the due date for the 2021 financial years. If there's no tax payable and no prior rate returns and you had a tax agent, or if you're an individual in a trust and you pay all of your tax due on this date. So it's not an official due date, but it is an important date to note. It's like a concessional due date that tax agents get. The 20th of June is the date that we recommend that you pay your employee super if you're using Zero Auto Super, so that it hits the super funds by the correct date so that you can get that deduction at the end of the year, at the end of this current year. 27th of June, FBT returns are due. if you have a tax agent, and if you have an FBT, if you have to report FBT, then that's when those returns are due. 30th of June, that's when you would do your stock take or do your final stock take if you still have some items that haven't been counted or haven't formed part of a periodic stock take during the year. And 30th of June is also the date when the trust resolutions are due. The rest of the items you can go through at your leisure when you receive the slides. We have highlighted some others during the presentation, but recommend going through this. You might want to use this as a guide. There are a few more, but go through them in your own time. So just how we can help. At Fullstack, we offer a full stack of services when it comes to tax and accounting. And if there are any items that you need help with, please feel free to reach out to us. You can book a discovery call via our Calendly link, calendly.com/fullstack. Send us an email, team@fullstack.com.au, or have a look at our website to see what services we offer.